Hello everyone and welcome back to another video. In today's video, we are going to be talking about why Amazon stock has been rallying so much, why Figma is crashing after its earnings, and if the stock is looking interesting now, Lululemon stock falling 20% after earnings, and if that stock is looking cheap, why Warren Buffett is continuing to sell down his Apple position and build up his cash position, and if I think investors should be following Warren Buffett and building their own cash positions now as well. This is going to be another action-packed video, so let's hop right into it. So let's start off today's video by discussing why Amazon stock popped 4% yesterday, and it was because of an article that came out from Semi-Analysis. So we're going to go through this article quickly, and I want to show you the highlights that I found. So here is the article that Semi-Analysis put out, and this goes through their thesis as to why AWS will re-accelerate into the second half of 2025. The thesis is basically that Anthropic, which is a ChatGPT competitor and is using AWS heavily, is scaling rapidly and is about to increase its spending on AWS's platforms and from their data centers. Basically, Anthropic is growing extremely quickly, and as they grow, they will spend more money with AWS, which should also accelerate AWS's growth. In Semi-Analysis article, they wrote, Microsoft Azure now leads the market on quarterly new cloud revenue, and the gap between Google Cloud and AWS has materially narrowed. Then we can see in the chart below that Microsoft Azure has been generating the most net dollar growth to their cloud platform, and that the gap between AWS and Google Cloud is growing. And this was really the main concern from Amazon's last earnings report. It became extremely clear that Amazon seems to be losing market share in the cloud space as Google Cloud and Microsoft Azure are growing significantly faster, and they saw their revenue growth rates accelerate, whereas AWS saw its revenue growth rates were basically flat on a quarter-over-quarter basis. This caused a lot of people to say that AWS is losing the cloud race and that their competitors are taking market share and catching up. But this article kind of dives deep into why that may not actually be the case and why Amazon could be kind of just seeing a delay as to their re-acceleration of revenue growth. So let's move on to the next screenshot now, where this says, we laid out our thesis a month ago, forecasting an upcoming acceleration beyond 20% year-over-year growth by the end of 2025. Then they provided a chart that says, Anthropic's first AWS gigawatt scale cluster begins operations sometime around September of 2025, which is in the second quarter. Then they also say, Anthropic's second AWS gigawatt scale cluster begins operations sometime in the fourth quarter of 2025. So over the next couple of quarters, there is going to be two large AWS data centers coming online that have the sole purpose of training Anthropic. And once these data centers come online and Anthropic can get access to them, then this should materially boost AWS's revenue. In fact, Semi-Analysis is saying here that by the second quarter of 2026, they're expecting AWS's revenue growth rates to accelerate all the way up to 25.3%. And I do not think that the market was pricing this in. So once this article came out and the logic and reasoning seems pretty solid, that's why the market bid up Amazon shares, just in case this person ends up being right. But continuing on through the article, this says, Azure's AI performance over its peers is entirely driven by its OpenAI partnership. As of the second quarter of 2025, all of OpenAI's over $10 billion in cloud spending is booked by Azure. This basically means that OpenAI's growth has materially benefited and accelerated Microsoft Azure's growth as well. And this is why Microsoft Azure is seeing such a re-acceleration of revenue, is because OpenAI is solely using Microsoft Azure. And again, as OpenAI grows and they need more data center capacity and more cloud capacity, they're going to Microsoft, and Microsoft is getting all of that revenue. The thesis here is that as Anthropic now grows and catches up to ChatGPT, the exact same thing should happen for Amazon and AWS. This next screenshot says, Amazon's bet has been the right one. Anthropic is the clear outperformer in 2025 in the generative AI market, with revenue surging from $1 billion to $5 billion annualized. In this context, AWS's underperformance understandably frustrates investors, but they're misunderstanding the composition of Anthropic's spending on training and inference. Then Semi-Analysis shows us a chart of OpenAI's revenue and Anthropic's revenue, And we can clearly see that Anthropic is now catching up, and Anthropic has 5x'd their annual recurring revenue in 7 months. So Anthropic's business is absolutely exploding right now. However, the article then explains, as of the second quarter of 2025, Anthropic's cloud spending is over 2 times smaller than that of OpenAI. A larger share of Anthropic's spending is also going to Google Cloud, one of Anthropic's first major investors, and preferred cloud partner in 2023 and 2024 before it expanded the AWS deal. So another key point here is that Anthropic historically has been using Google Cloud more than AWS. But in 2024, they did sign and expand a deal with AWS to use them as more so a preferred cloud provider. And then SemiAnalysis provides a chart here where, based on Anthropic's growth and their new deal with AWS and those 2 new data centers coming online, AWS's revenue is projected to grow massively over the next couple of years due to Anthropic using them more. And this is why SemiAnalysis thinks that AWS's revenue growth rates are about to reaccelerate as Anthropic starts using these data centers and deepening their relationship and partnership with AWS. AWS is basically about to see its Microsoft Azure moment, that's the thesis here, where OpenAI materially benefited and accelerated Microsoft's business. Copy-paste that for Amazon and Anthropic. In the next screenshot, they also have satellite images, which is pretty intense. And they say, we show below 3 AWS campuses in the final stages of construction, boasting over 1.3 gigawatts of IT capacity for the sole purpose of serving Anthropic's training needs. The speed of construction is remarkable. So Amazon actually has 3 data centers with a total of 1.3 gigawatts of power that are solely going to go to Anthropic and training their models. So once all of these data centers come online over the next 3 years and Anthropic can start to use them, that should materially benefit AWS's growth. Now moving on to the next screenshot, this says, we think the 3 large AWS campuses will meaningfully contribute to AWS's top line by the end of 2025 and jack up growth above the 20% threshold. And once again, they show that same chart from earlier, and they believe that AWS's revenue growth rates will accelerate to 25% by June of next year. So we're going to have to see how this all plays out. Obviously, as an Amazon shareholder, I really hope that this plays out, because it would be great to see AWS's revenue growth rates reaccelerate with Google Cloud and with Microsoft Azure. So I am cautiously optimistic, and I'm going to be paying attention to all of this news. I have not purchased any more Amazon shares after this news came out. And personally, I do think that Amazon is trading slightly below fair value right now, but pretty dang close to fair value. So I'm not an active buyer of Amazon, but I'm also not selling. Amazon for me right now is a hold, but I can also see why people may want to buy in after this news, because if this does prove to be right, then it could be pretty dang bullish for Amazon over the next year or so. Yesterday, Amazon also had some pretty interesting news in regards to Kuiper. So this says, Amazon stock pops after Project Kuiper lands JetBlue internet deal. In this article, it says, after launching its first batch of satellites in April, Project Kuiper has placed more than 100 satellites into orbit and aims to launch more than 3,200 satellites overall. In comparison, Starlink operates over 8,000 satellites in low Earth orbit. Project Kuiper has been inking deals with enterprise customers as it ramps up its service in preparation for a wider commercial launch. For instance, earlier this year, Project Kuiper announced an agreement with Airbus to integrate its technology into the plane maker's aircraft. Now, for those of you who may not know, Project Kuiper is Amazon's version of Starlink. So they want to provide satellite internet across the globe. I am extremely bullish on this. I also think that it is very good that there is going to be competition in the space, because right now Starlink does have a monopoly on satellite internet. So I do like to see that Amazon is getting involved. I also like to see that they're already signing commercial contracts, and customers seem like they want this internet. Like, think about when you go on an airplane. The Wi-Fi on airplanes is absolutely atrocious. Even when you go on cruise ships, Wi-Fi is pretty much non-existent or it's terrible. Satellite internet is going to completely change that. We are going to have high-speed internet while flying on planes in the next few years, probably within the next 5 years. Amazon is going to be one of the companies offering this service. This service is also going to be extremely great for people who live in rural communities and maybe don't have access to high-speed internet. Satellite internet is going to change the game for these people. You're basically going to be able to have internet anywhere in the world, and it's going to be fast, reliable internet. So you're not going to be stranded in the mountains anymore, which I have unfortunately experienced. I've been lost on hikes. I like to go hiking in the mountains over here near Calgary, Alberta. And it would be really nice to just have some internet on these hikes. I would feel a lot safer. And these companies are going to be the ones who will help provide that service to everyone around the globe. And I would definitely be someone who pays for this. I think that this is going to be extremely useful and a huge benefit to society overall. So Amazon is working on that. They're signing deals, and I think that this could be a pretty good story for the stock and boost the fundamentals over the long term. Amazon did tell investors that they are expecting to have some small commercial contracts signed by the end of 2025, but by 2027, they should have some larger contracts signed. The limiting factor here is just getting their satellites into space. So they want to ramp up the amount of satellites that they're launching, get a lot more satellites into space, and then start ramping up their commercial contracts. So I don't think that this is necessarily going to be a benefit to Amazon's business and its fundamentals over the next year or so. But over the long term, I think that this is going to be a brand new business line for Amazon. I'm very happy they're doing this, and I think that it could meaningfully add to the fundamentals over the long term. This is also one of the reasons why I love Amazon's business, is because they're just so innovative. They have their hands in everything. This company it's just phenomenal. And it's becoming like a massive technology ETF. They've got robotics, they've got e-commerce, they've got AWS, they're going to have satellite internet. They even have renewable energy. Like, Amazon is so much more than just Amazon.com. And that's part of the reason why I own it. I truly think that they're one of the most innovative companies in the world. And it's going to be exciting to see what this company does over the next 10 to 20 years. So for me, Amazon is definitely a hold. I am happy that it's in my portfolio, but I'm not looking to buy more right now, as I do believe that the stock is selling for right around fair value. And I think that there are better opportunities elsewhere in the market. So that's the update on Amazon. That's what I'm doing with my position. And that's some of the recent news that has come out. All right, let's now move on to the next topic that I want to discuss, which is Figma. I actually did discuss Figma before its IPO happened, and I basically said that I am not interested in the IPO unless the valuation of the business was under $16 billion. That absolutely did not happen. Figma was like one of the hottest IPOs that I've ever seen. The stock got bid up all the way to around $123. And at one point, I believe that the valuation of the company was $80 billion, which is absolutely insane. This company is doing around $1 billion in annual revenue right now, which means that at its peak, it was selling for 80 times sales. That is too high of a price for me to pay for any business. I don't care what the business is. 80 times revenue is such a high price that you're almost guaranteed to lose money on your investment over the long term. It's simply way too high. I believe that was also trading for about 200 plus times cash flows, where if you compare that to Palantir, maybe it's cheap, but still, it's freaking expensive, okay? But now the stock has dropped by 56% from its all-time highs. It also reported its earnings the other day, and the stock fell another 22% after earnings. This has caused a lot of people to ask me if Figma stock is looking attractive now, and I have been asked to share my thoughts on the earnings and the valuation today. So I went through the earnings and I took screenshots of the highlights that I found. So let's go through them really quick, and then I'll explain my thoughts on the valuation. So here we can see that Figma's second quarter revenue grew 41% year over year to basically $250 million. This is really strong revenue growth. 40% plus revenue growth is incredible. Then the CFO said, "We delivered best-in-class revenue growth and positive operating margin as we kept investing in AI and expanded our platform. Our 129% net dollar retention rate also shows that our customers are continuing to deepen their investment in Figma's platform. Income from operations was $2.1 million, and the operating margin was a whopping 1%. Net cash provided by operating activities was $62.5 million. Operating cash flow margin was 25%. Adjusted free cash flow was $60.6 million, with an adjusted free cash flow margin of 24%, and cash equivalents and marketable securities were $1.6 billion at the end of the quarter." So Figma's business is growing strong. It is producing tens of millions of dollars in quarterly profits, and it does have a lot of cash on the balance sheet. So in terms of the actual risk to Figma's business, it's very low. They're cash rich, they're producing money, and they're growing extremely quickly. It has everything that looks like it is actually a high quality business. So moving on to the next screenshot, this is their outlook. And here they say, revenue between 263 million and 265 million, implying a 33% year-over-year growth rate at the midpoint of the range. That's the outlook for the next quarter. Then their outlook for the full year is revenue between 1.02 billion and 1.025 billion, implying a 37% year-over-year growth rate at the midpoint of the range. And I think the outlook is partly why the stock dropped so much after the earnings report. Because in the second quarter that they just reported, they grew revenue 41%. Now next quarter, they're projecting revenue growth to decelerate all the way down to 33%. And I did the math. I will not do the math in this video, but I did do the math. And based on the amount of revenue that they produced so far this year, their projection for next quarter, that leaves us with their revenue estimates for the fourth quarter, which is roughly $280 million. On a year-over-year basis for the fourth quarter, this is revenue growth of 29%, which is a further deceleration in revenue growth rates from the third quarter outlook. So basically, Figma just had a 41% revenue growth quarter. Next quarter is going to be 33%. That's their expectation. And then their outlook is suggesting that the fourth quarter is going to decelerate more to 29% revenue growth. So Figma's revenue growth rates are projected to decelerate quite substantially over the next couple of quarters, but 29% revenue growth is still pretty dang good for any business. The problem is that Figma's share price was so freaking expensive that it wasn't pricing in 29% revenue growth. In fact, I think it was pricing in even more than 40% revenue growth. And that's how investing works. You can buy a stock and the underlying business can continue to grow and quite rapidly. But if you pay way too much, even for that fast growth, then you can end up losing money on your investment. The stock and the business are two different things when you're investing. And that's why for me and on my channel, I do focus heavily on the price and the valuation that I am paying for any stock, because there is a price that makes sense for Figma's business. And $80 billion was definitely not the price that made sense. In my opinion, it's 12 to 16 billion. That's where the stock becomes around interesting for me. So let's move on to Figma's cash flow statement now. And here we can see that the company's operating cash flows came in at $62.5 million for the quarter and about $160 million so far year to date. Now, what I found kind of shocking is that Figma only did $7.3 million of stock-based compensation so far in 2025, which actually isn't that much relative to the business's overall profits. So Figma is not doing a lot of stock-based compensation, which for me is actually a green flag, and I do like to see this. What I also like to see is that the company's capital expenditures are only $1.1 million so far for the year. This means that almost all of their operating cash flows becomes free cash flows for the business, and this is a highly profitable company. What also interested me is that Figma purchased $286 million worth of stock and $525 million worth of stock so far year to date. They also purchased $30 million of digital assets, which I believe they said they were purchasing Bitcoin, but they are also investing in cryptocurrency, which personally I do not love to see. So overall, this cash flow statement is pretty dang good. They're producing a lot of operating cash flow. CapEx is extremely low. They're very free cash flow positive. And stock-based compensation is not ridiculously high. And very quickly, before we move on with the video, I want to let you know that if you're interested in learning how to read financial statements and doing fundamental analysis, then I just launched a brand new 28-hour investment course over on my website, www.danielpronk.com. If you're interested in taking your investing to the next level and really understanding how to do fundamental analysis, identify red flags, go through financial statements, learn how to identify moats, learn how to analyze management teams, then this course is for you. I've been working on it for over 18 months. I put my heart and my soul into this course. I left no stone unturned. Guys, it's 28 hours long. There's so much content there. And I am so convinced that this course is going to be worth your time and your money, that there is a 14-day money-back guarantee, no questions asked. So if you go and buy the course and you know what, maybe you're not happy with it, maybe you decided you don't have enough time to go through all the videos, there's 28 hours, there's a lot of content, then I'll give you a refund. It's literally risk-free. So if you're interested in getting access to my new course and leveling up your fundamental analysis and your investing, then click the link at the top of the description and check out my new course. The reviews have been absolutely incredible so far, and people have been loving it, and I think that you will too. But with that being said, let's get back into our Figma analysis. So let's head over to Figma on Stock Unlock now. And here we can see that it has a market capitalization of $26.2 billion as of today, after falling 56% from its all-time highs. Now, Figma is projecting to produce somewhere around $1.025 billion in revenue for this year. So let's give them a free cash flow margin of 35%. This means that the business could potentially produce around $360 million in free cash flow this year. So let's now enter in their market capitalization of $26.270 billion. Let's divide this by their free cash flow potential this year of around $360 million. And we get a price to free cash flow of 73 still today. This is still an incredibly, incredibly high price to pay for any business. And Figma's business, again, it's seeing its revenue growth rates decelerate down to 29%. And in my opinion, paying a 73 times multiple for 29% revenue growth is still a freaking high price. For example, Mercado Libre, which is a stock that I own in my portfolio, is trading for around 25 times cash flows today, my estimates of their free cash flow potential. And Mercado Libre's business is growing by over 35% annually and consistently. So Mercado Libre is now growing faster than Figma, and it's trading for about 1/3 of the price. So Figma, I think, got overhyped in the market. I think that it is still extremely expensive. It's still got a lot of future growth priced in, and it's simply not interesting for me. And this is why, in my opinion, the stock is down so much, is because the valuation got so disconnected from its underlying fundamentals and its growth that the only way the stock had to go over the long term is down. And if I had to take a gamble here, I definitely don't know what the stock is going to do. But if you forced me to guess, I would say this thing is still overvalued, and its fair value is going to act like a magnet and bring the stock down towards it. So I would speculate that there's more downside than upside potential on Figma's stock today. And for those reasons, I'm still not interested in purchasing the stock. And that's pretty much my thoughts on Figma today. All right, let's now move on to the next topic that I want to discuss, which is Lululemon. This company just reported its earnings, and it's down over 17% on the day. If we also zoom out, we can see that Lululemon is now down over 60% from its all-time highs. I can't quite get that last tick right there, but it's down over 60% now. This company was once a darling of the stock market. And for those of you who may not know, this is an apparel business that kind of is more a high fashion, I would say. Their clothing is actually quite expensive. I have some clothing from them, and I only ever get Lululemon if it's a gift, because personally, there's no way I'm buying expensive clothing like Lululemon. So this business has been seeing a lot of weakness. They just lowered their guidance. They just reported earnings, and it seems like people are still getting very bearish towards them. So I want to go through the highlights and show you what I found. Here we can see that Lululemon's total net revenue increased by 7%, or 6% on a constant dollar basis. Total net revenue was $2.5 billion in the second quarter, compared with $2.4 billion in the second quarter of 2024, and global comparable sales increased by 1% year over year. America's net revenue increased by 1%, however, comparable sales declined by 4%, or 3% on a constant dollar basis. So in America, on a same-store sales basis, Lululemon saw its revenues decline. The only reason it saw its net revenues grow is because they opened more stores, which caused overall revenue in America to actually grow. But again, on a same-store sales basis, they did see a decline in America. China mainland net revenue increased by 25%, or 24% on a constant dollar basis, and comparable sales in China increased by 17%, or 16% on a constant dollar basis. So Lululemon's China revenue is continuing to grow, and quite strong. Rest of the world net revenue increased by 19%, or 15% on a constant dollar basis, and comparable sales increased by 12%, or 9% on a constant dollar basis. So basically, outside of North America, Lululemon is actually doing quite well. However, over 70% of the revenue comes from North America, so this is the vast majority of their business, and the majority of their business, therefore, is not performing too hot. Moving on to the next screenshot, this is their income statement. And here we can see that the revenue came in at $2.525 billion this quarter versus about $2.37 billion versus the same quarter last year. Gross profits also grew to $1.48 billion versus $1.41 billion last year. However, the gross margin did decline by roughly 2% year over year, which is not the best to see. That ultimately means that their margins are declining slightly and the profitability is going down on a year-over-year basis. This is also true for Lululemon's operating margin. Here we can see their income from operations was $523.8 million this quarter, whereas last year it was $540 million. So Lululemon's operating income declined year over year, despite their revenue growing by 7%. So the company's profit margins are going down. We can also see that net income came in at $371 million versus $393 million last year. So the earnings of the business and its profitability is going down, and once again, its margins are declining. Earnings per share were $3.10 versus $3.15 last year. So overall, this seems like a business where its profitability is being constrained, it's being depressed, and its margins are going down, which is not ideal to see. Because at the end of the day, all that matters, all that creates shareholder value is the per share profits of the business growing. So even though revenue grew 7% year over year, the per share profits are starting to go down now, and that means that shareholder value is not growing. So now let's move on and take a look at Lululemon's outlook for the third quarter and for the rest of the year. And here they say, for the third quarter of 2025, the company expects net revenue to be in the range of $2.47 billion to $2.5 billion, representing growth of 3 to 4%. Diluted earnings per share are expected to be in the range of $2.18 to $2.23 for the quarter. And in my opinion, this is partly why the market is responding so poorly to Lululemon's results, is because their outlook was lowered quite substantially. For the next quarter, they're expecting revenue to decelerate from 7% growth in the quarter they just had down to 3 to 4% in the next quarter. So they're expecting their business to continue weakening in the next quarter. Then for the full year of 2025, they're now expecting net revenue to be in the range of $10.85 billion to $11 billion, which represents growth of 2 to 4% for the full year. Lululemon is also expecting diluted earnings per share to be in the range of $12.77 to $12.97 for the full year. And they say that this guidance for 2025 includes an estimated reduction in gross profits of approximately $240 million, reflecting our current assumptions about higher levels of tariffs on imports into the United States. Now, why this is so bearish for Lululemon is because they're expecting their earnings per share to start declining into the remainder of the year. On the high end, they're expecting roughly $13 in earnings per share. And if we go and take a look at Lululemon's financials here, let's go over to their income statement, head over to EPS. We can see that in the trailing 12 months as of the first quarter, they produced roughly $15 in EPS. And if we take a look, the last time the company produced around $13 in EPS was all the way back in, what would that be, the second quarter of 2024. So Lululemon is expecting their profitability to decline quite substantially over the next couple of quarters. Quite literally, the company's earnings are now declining. And this is definitely not ideal to see. Now the question is, does Lululemon stock look cheap, and is this presenting an opportunity? Well, if we take the share price of $170 if we round up, and we divide this by $12.97, which is their high-end estimates for earnings for the remainder or for the full year of 2025, then we get a price to earnings ratio of 13. So this is what Lululemon is selling for based on their expected earnings for 2025. Now, in my opinion, a PE of 13 for a business that is currently seeing a lot of headwinds and their earnings are actually declining is not actually that attractive. And the reason this is not attractive for me is because if Lululemon's earnings continue to decline by another 15% next year, then the price to earnings ratio on cost of the shares purchased today would increase to 15. This is what happens when a business's profits are going down. You may look like you're getting a low price to earnings ratio on cost today, but if the earnings of the business continue to decline, then your price to earnings ratio on cost goes up, which makes your purchase price look a lot more expensive. And I have absolutely zero idea if Lululemon's earnings are going to rebound next year or in 2027 or whatever. I have no idea what the future of this business looks like. Which brings me over to a document where I just wrote out my quick thoughts. So here are my thoughts on Lululemon now. For 13 times earnings for a struggling business is simply not appealing to me. I am finding businesses selling for similar multiples where the fundamentals are continuing to grow and the business is not seeing so many headwinds or earnings declining. Additionally, I do not invest in fashion companies, as I have no idea how to predict consumer trends and behavior. I have no idea what will be popular in 5 years. One of the key pillars of my investment strategy is the moat of the business. And in my opinion, I just don't know what the moats of any fashion business are. And I think that Lululemon provides a really good example of this. Lulu was a very hot brand for many, many years. It saw tremendous growth. It was resonating with consumers. But what seems to be happening now is Lululemon's core brand, its core offering, is no longer resonating with consumers. And I have a note further down here that I wrote out that the CEO himself has said that the core brand, the core apparel of Lululemon is no longer resonating with consumers, which suggests that Lululemon needs to kind of reinvent itself. It needs to reinvent its products. It needs to reinvent its marketing and its branding to resonate with the current consumer trends and the consumers that are now coming up, the new generation, so to speak. And this is why apparel companies are so freaking challenging for me to understand, is because I don't know what the next generation is going to be interested in. And I don't know if the current consumer trend is going to be maintained for the next 20 years or even the next 5 years. And when a company's revenues and cash flows are so unpredictable, it means that I cannot accurately forecast what the profits are going to look like in 5 years and if the price that I am paying for the business today is actually going to be attractive. It's just way too unpredictable for me. And I think that Lululemon, again, is providing a perfect example of an apparel company that had absolutely phenomenal fundamentals and metrics that is now just falling off a cliff because they essentially need to reinvent their entire image, their brand, because it's not resonating anymore. Basically, what that means is apparel companies do not truly have lasting, durable, recurring revenue. They need to constantly stay on top of consumer trends, reinvent themselves, reinvent their brand every so often to maintain their customer base and maintain their fundamentals. That's a short way of me explaining all of the points here that I wrote down. If you want to pause the video and read them, then you can, but that's really the heart of my argument against apparel companies in general. Now, I also got asked by one of my Patreon members earlier in my Discord today, Daniel, what should I put in my DCF to project out Lululemon's future and see if the stock is looking attractive today? And my honest answer was, I have no idea what you should put in a DCF, because whenever I do a DCF on an investment that I own, I want to feel like I have the ability to at least predict what the future of the business could look like. Therefore, if I don't know how to predict what the future of the business could look like, then the reality is the DCF is useless. It's me just guessing, and it's me just hoping that, hey, my DCF is going to work out. So for me to even do a DCF on a business, I have to have faith or at least some sort of conviction in what the business is going to look like 3 to 5 years out into the future. And if I don't know what the business is going to look like, then a DCF is more so tricking me than anything else. So I don't even know how to run a DCF on an unpredictable business where I don't know what Lululemon's numbers are going to look like 3 years out, if they're going to be disrupted or if a new apparel company is going to come up and start taking their market share. Like American Eagle, after that Sydney Sweeney campaign, it looks like their numbers are doing well now. So is American Eagle now back on top? Are they taking market share? I have no freaking clue. So apparel companies, in my opinion, are uninvestable just for me and my own investment style. I have always said that. It's not a stock that I'm looking to touch. And a 13 PE ratio for a company where its earnings are declining doesn't really look that attractive to me quite yet. But hey, if they can actually turn the business around, if they can get their earnings growing again next year, then maybe this purchase price does look attractive. But you have to have conviction that the business is actually bottoming out here and that things are going to improve and get better going forward and the earnings are actually going to grow. But those are my thoughts on Lululemon, and I'm definitely not touching the stock today. All right, let's now move on to the next topic that I want to discuss, and that's that Warren Buffett is continuing to trim down his Apple position, and Berkshire Hathaway's cash position is continuing to grow. A lot of people online are saying that this is a sign that Buffett is trying to time the market and that he thinks a massive stock market crash is coming. I want to share my perspective and opinion as someone who has studied Buffett for the past 6 years now, almost religiously, and he's my icon, he's my idol. So I want to share my perspective as someone who knows Buffett pretty well, his investment style pretty well now, and what I think he's doing here. So this chart shows Buffett continuing to trim down Apple. Here we can see that Apple is continuing to make up a smaller and smaller portion of the overall Berkshire portfolio and the position in terms of total dollar amount is continuing to decline. This is very clearly Buffett continuing to trim down his Apple position. Now the next screenshot says, Berkshire Hathaway's cash pile, an ominous sign. And this chart shows that Berkshire Hathaway's cash position plus its treasuries, which is basically just cash, is 347.7 billion, and it is sitting at an all-time high. Again, people are saying that this is a sign that Buffett is thinking the market is expensive, we're in a bubble, and a crash is coming. So here's my opinion on Buffett trimming down Apple and building up cash. So first off, I think that he is timing the market based on value. I do not think that he is timing the market and speculating what the market is going to do over the next year or so. Buffett has been extremely consistent over his entire investment career that he has never made an investment decision based on what he thinks the market is going to do in terms of price over the next year or even 5 years. He doesn't try to time the market price at all or try to predict if the market's going to fall next year. Now, with that being said, the second form of timing, which the intelligent investor actually talks about, I have a screenshot we're going to take a look at, is entirely based on value. Benjamin Graham, the author of The Intelligent Investor, made it very clear that there are two types of timing the market. The first one is speculating, and that's you trying to just guess what the market price is going to do of any security or the market as a whole. The second form of timing is buying and selling stocks based on their underlying value and what their price is relative to that value. So I'll bring up the screenshot now from The Intelligent Investor. And here Benjamin Graham wrote, "Market fluctuations and a guide to investment decisions. Since common stocks, even of investment grade, are subject to recurrent and wide fluctuations in their prices, the intelligent investor should be interested in the possibilities of profiting from these pendulum swings. There are two possible ways by which he may try to do this, the way of timing and the way of pricing. By timing, we mean the endeavor to anticipate the action of the stock market, to buy or hold when the future course is deemed to be upward, or sell or refrain from buying when the course is downward. By pricing, we mean the endeavor to buy stocks when they are quoted below their fair value, and to sell them when they rise above such value. A less ambitious form of pricing is the simple effort to make sure that when you buy, you do not pay too much for your stocks. This may suffice for the defensive investor, whose emphasis is on long pull holding, but as such, it represents an essential minimum of attention to the market levels. We are convinced that the intelligent investor can derive satisfactory results from pricing of either type. We are equally sure that if he places his emphasis on timing and the sense of forecasting, he will end up as a speculator and with a speculator's financial results. This distinction may seem rather tenuous to the layman, and it is not commonly accepted on Wall Street. As a matter of business practice, or perhaps of thorough conviction, the stockbrokers and the investment services seem wedded to the principle that both investors and speculators in common stocks should devote careful attention to market forecasts. So what Benjamin Graham is writing here is once again that there's two different forms of trying to time the market. One is trying to speculate on where prices are going to go in the future, just entirely basing it on pricing. And the second is trying to buy stocks below fair value and sell stocks when they get above fair value. The second option is what he says he thinks investors should focus on, and that they can derive a satisfactory result from focusing on value, buying when stocks are undervalued and selling when they are overvalued. Now, going back to the Warren Buffett discussion, I believe that Warren Buffett is selling his Apple stock not as a hedge against a market correction or anything like that. I think he's simply selling because Apple is looking ridiculously expensive. This stock is now trading for almost 37 times cash flows, which is a free cash flow yield of only 2.7%. This means that if Apple took 100% of its free cash flows and paid out a dividend or bought back shares, it could only pay a 2.7% dividend or buy back 2.7% of its share count. This is also a company that is struggling to grow now. Apple's revenues are not really growing and its free cash flows have not grown in, I believe, 2 years now. So investors are paying a 37 multiple, which is equivalent to a 2.7% free cash flow yield for a business where the cash flows are no longer growing. Now, this is at the same time as 10-year government bond yields are offering 4.23%. And you can very clearly see that Apple's free cash flow yield is now below what a 10-year government bond yield is offering. And what Buffett does is he compares the yield of the stock versus the yield of the risk-free rate, which is the 10-year government bond yield. So what I think Buffett is doing is he's simply looking at Apple's free cash flow yield, how much cash the business can return to him, versus what the risk-free rate is. And he's saying, you know what, I could get a higher risk-free rate by buying bonds instead right now. So he's selling down his Apple position and getting a higher interest rate by buying government bonds. I believe that's what he's doing. And in my course, I know I'm plugging my course again, but I talk about the margin of safety and valuations, and I go through Warren Buffett's Berkshire Hathaway letter to shareholders, and I found exact quotes from him where he compares the yield of a stock against the yield of bonds to determine what is a fair value for a business and what is a margin of safety. And right now, based on his own writings, I would say that he has concluded that Apple is no longer offering a margin of safety. It's a very expensive stock, and he can get higher yields and results by buying risk-free investments instead. Now, to really drive this point home, when Buffett was loading into Apple stock in 2016, it was offering a free cash flow yield of almost 12%. It was extremely, extremely cheap. This was at the same time as the 10-year government bond yield was only 1.7%. So when he was looking at Apple shares in 2016, he was seeing that Apple was offering a 10 times higher yield, going in yield, than what bonds were offering. This meant that Apple was offering a massive margin of safety, and he was getting an extremely higher yield on his dollars invested in Apple versus buying government bonds. But fast forward to today, and that relationship has completely changed. Bonds are now offering a higher yield than Apple stocks, and that is why he is selling Apple to go and buy bonds instead. I really think it's that simple. I do not think that he is trying to time the market or that he's building up cash to say, hey, I think a market correction is coming next year. I think he's just looking at where every dollar is best invested. And right now, Apple does look very expensive, especially relative to a 4.2% interest rate. So he's making that switch in his portfolio. Now, I've also seen people online saying that since Berkshire Hathaway is building cash, every investor should also be building a massive cash pile too. I completely disagree. You have to understand that Berkshire Hathaway is now working with $370 billion. And let me use my own portfolio to put this into perspective. I have recently been buying an Australian company with a $620 million market cap. For me, I could easily put my entire portfolio into this business. And then if the business 5Xs, my entire portfolio will 5X. Now, if Warren Buffett found the same business and he thought it was an interesting opportunity and he wanted to go and buy the entire company for $620 million, then it would make up 0.18% of the entire Berkshire Hathaway portfolio. If that company then went on to 5X, Warren Buffett would make a whopping 0.6% return. What this means is that smaller companies and even mid-sized companies now simply are not worth Buffett's time to even take a look at. Because if he could go and buy the entire company, and then that company goes on to be wildly successful, he won't make a large amount of money. It will not move the needle for him. So Buffett has very clearly told investors that his world of investable stocks, his investable universe, is like 50 companies now. He can only buy and focus on the largest businesses in the world. So our investable universe, as smaller investors, as your everyday investor, is so much larger. And I am finding extremely interesting opportunities still in the market, especially in the international markets. And I also believe that if Buffett were in my shoes, he would be fully invested in something. He would not be building cash right now. I think that he doesn't actually want cash. And if he were a smaller investor, he would have no cash. So I don't think that us as regular retail investors should be looking to what Warren Buffett is doing and building cash in his portfolio and saying, yeah, we should be building cash too, because we're simply not in the same universe. We're not even close to being in the same investment realm as Warren Buffett anymore. So for me, I'm not looking to what Buffett is doing with his cash position and saying, oh, well, I should be building cash too. I simply think that he can't find anything intelligent to do with $370 billion. That's not the position I'm in. I'm in a position where I have a significantly smaller portfolio, and I can still find very intelligent and interesting things to do with my money in my portfolio because I have so many more opportunities to look at. So I don't think that we should be looking to Buffett or him building cash. And I also don't think that we should be looking at people on social media saying there's warning signs that Buffett is trying to flash by him building cash. I think that this is all just trying to generate clicks, trying to generate fear and grab your attention. But as someone who has followed Buffett, I strongly believe that these people are wrong, and it's not the right way to think about investing. All right, and with that being said, that is going to wrap up today's video. So if you did enjoy this video, then please remember to leave a like on it. And once again, if you are interested in checking out my brand new 28-hour-long investment course, then the link will be at the top of the description, and I think that you will truly enjoy it. As always, thank you so much for tuning in. I truly do appreciate it, and I really hope to see you all again in my next video.